Welcome to the latest installment of ABL Advisors video series featuring thought leaders from the commercial finance industry. I'm Mike Toglia, the publisher of ABL Advisor, and today my guest is Mikhail, founder and CEO of Stratton Equities. Michael, thanks very much for being here today.
Thank you, Michael.
Today, we're going to be talking a bit about the role of hard and soft money commercial real estate loans and the role they play in the market, as well as getting some of your thoughts as to what's happening in the commercial real estate market in the current environment. With that being the case, Michael, are you okay if I just started on some of the questions?
Absolutely.
Okay. Well, I think probably the best place to start for some folks who aren't as familiar with this type of financing is maybe to explain the difference between a hard money and soft money commercial real estate loan.
Okay. So regardless of if it's commercial or 1 to 4, a hard money loan, a true hard money loan is an asset-based loan. It's always going to be a bridge loan. There is no such thing as a 30-year or 5/1 ARM hard money loan, even though a lot of people think so, but that's not the true terminology of it. So hard money now, since 2012 and 13, has been more institutionalized. Prior to that, 20, 15 years ago, really wasn't much institutional financing that supplied that type, right? It was somebody that had money, somebody that retired, they sold their company, and you literally had to find somebody that just had a lot of money that wanted to invest in the real estate, and that's kind of how it started. So I bought my first property like that in Florida. Was 19 years old. My rate was 24%, right? Because it was just somebody that just said, "Here you go have this money," and always, short-term financing, et cetera, et cetera. Soft money, we pretty much coined it and created soft money. It is a hybrid between conventional financing and more private money per se than say hard money. And right now, the way the market is and rates are, it's actually benefiting us and our clients tremendously. And I'll give you an example with that. Last year, when rates were close to 2%, soft money or our no-doc programs were still 4 and change, depending on obviously the borrower's qualifications. The only benefit to that was, right, you had a lower rate, but now your LTVs are lower because bank and conventional conforming guidelines, let's just say 1 to 4 family, is maxed at 70 LTV. Your job history, your income, all that stuff, right? The only benefit to that was, okay, I got a much lower rate, but then your LTVs are lower. Now, our rates are beating conforming and conventional rates. We're talking about 1 to 4 families now, and the LTVs are higher and the documentation is less. The rates are going up now, as we know, with the Fed. But 2 weeks ago, we closed a loan, single family, Georgia, but very qualified borrower, being FICO. We did an 80 LTV no doc loan, which is similar to the soft money loan, at I think 7.25 on a 5/1 IO. So not looking at the person's job history, closing in an LLC, not scrutinizing every dollar on their income and whatnot, so a lot less paperwork, and 10% higher LTV than a bank would do or a traditional lender, and at the same rate. So if not lower, we're at 7.25 on a 5/1 ARM. So really, right now in this environment, there's really no benefit to doing traditional financing on 1 to 4 family, and even some light commercial. Now, talk about light commercial, meaning like multifamily, 5-unit, mixed use. People don't really know how to segment commercial. They just say commercial. As you know, multiple categories and subcategories of commercial. So you're talking about like small mixed use, small multifamily, that is still very, very strong. The rates are still very strong on that.
Outside of the multifamily, when you say light commercial, what else would be light commercial, for example?
I mean, that's really light commercial, right? When you talk about commercial, banquet halls, restaurants, which we don't do, we don't like hospitality, warehouse, office, that's not considered light commercial. So light commercial is going to be, 51% commercial of mixed use, small apartments, like the ones you'd see in Newark or Jersey City, New Jersey. Some of them in Florida as well, Miami, or in Baltimore, 4, 5, 7, 10, 15, 20 unit, just kind of multi-families. That's, we do a lot of those, and we like those a lot, and we're very, very competitive on those. And that can fit into a soft money program per se. But if you're talking about large warehouses, like we did a Walgreens not too long ago, $4.5 million Walgreens, that is really not a soft money loan. We can do it on a no-doc commercial loan, but it would not be considered a soft money loan per se because of the LTVs don't go as high on those programs as well as on a 1 to 4 family or apartments.
Okay, so let me go back to the LTV for a second. Do you determine the LTV, the loan to value ratio, any differently than it would be a traditional lender? Do you go about the same process or the same exact process?
No, we go higher. We go higher because again, traditional lenders is going to be stuck to conforming guidelines.
Right.
So if you do a 1 to 4 family, agency conforming is 70 LTV. And I always tell the story. And a big thing we want to do with 2023 is education. A lot of education in the marketplace. So I always tell the story. A friend of mine's son wanted to buy his first investment property down the Jersey Shore. And this was last summer. He goes to traditional, credit unions, good banks, where most people do, and they wanted the same thing, 70 LTV, et cetera, et cetera. The father reached out to me. Now, if you're a new investor, this kid is 24 years old, you want to keep as much money in your pocket so you can invest in more properties. We did it at that time at 85 LTV. So if you're a new investor, not looking at 2-year job history, where most, I guess, 24-year-olds, that will be a little difficult to have 2-year job history, and then the income qualifications, and then needing to put 30% down instead of 15% down. Now we're at 80 LTV. Well, let's see what happens with the secondary market. If we can get back to 85, it helped him tremendously, not just in regards to the qualifications, but now he has 15% more reserves to go buy other properties.
Makes sense.
Just traditionally, people think, go to a bank, go to a credit union, go to a bank, go to a credit union. And a big reason for that is because there's a big misconception, because everybody just uses the word hard money. That's all, that's the only word people know. They don't know all the other categories and subcategories. So when people think in their head, oh, a company like Stratton Equities, I don't want a high interest rate, I don't want a low LTV, because people just know hard money. Hard money, which is an asset-based loan, and I'll give you a great example, is true asset-based financing, where you're looking at the equity and the property and the value of the property instead of as much the borrower. Meaning, if you don't have a good credit score, if you have recent bankruptcies, if you have recent foreclosure, and you as a borrower really can't qualify for financing due to your situation, but you have a great property in Miami, in LA, in somewhere in New York, where it's a great location and it has a lot of equity in it, then that's, or you just quick short-term financing, that is generally when you would go to more of a hard money or asset-based route. But most people just don't know these options, or they don't know how to use them. And that's why, they come to us, and our LOs are extremely well trained to be able to navigate people on which program is better for them.
Okay, good. Well, let's get to some misconceptions now. So many times there's misconceptions about the interest rates. We talked a little bit about that earlier, but I'm going to ask you to expand on that a little bit more. There's those misconceptions that, you're going to have a hard money or soft money loan. You're going to have exorbitant interest rates. Structures are going to be unusual. Tell me a little bit about fixed or floating rate. Tell me a little bit more about the structuring and the interest rates that are utilized, and how they present an opportunity for the borrower in the marketplace.
So our biggest program across the board, and we lend in 44 states, our biggest program is our soft money or our no doc. We do no doc on commercial and mixed use and 1 to 4. Again, hard money or a bridge is going to be a fix and flip, and a fix and flip loan, everybody, is not a hard money loan. It's a fix and flip loan. And like when people go, oh, hard money at 90 LTV. There is no hard money at 90 LTV. There's a fix and flip at 90 LTV, but to get that in everybody's guidelines, you're going to have the value add of the rehab budget, the ARV, et cetera, et cetera, et cetera, which then gets you to an 85 or 90 LTV on the purchase. If you're doing a straight bridge, which is called the straight bridge, max on a straight bridge in the good days is going to be 75 LTV. Now that's cut down. On a cash out, you're talking about 65, 70 LTV, which is more, which again is asset based. That's going to be, what people think is available.
All right, good. So we'll wrap it up with your expectations for the commercial real estate market as we enter what is a potential recession, whether we're in one or not, and more importantly, what's happening in commercial office space, for example, or whatever part you want to talk about. What do you think is going on in the commercial real estate market? What's going to happen over the next 12 months or so?
Well, in the real estate market as a whole, what's kind of keeping us from going heavily negative, I would say, is the fact that there's so little inventory, right? If we had tremendous amount of inventory right now with the way the economic environment is, I don't like to say bad words, but let's say it wouldn't be a very good situation. So kind of what's keeping things at bay is kind of what's happening with such a shortage on inventory. A lot of companies, as you know, from Goldman to all these big companies, are going back into the office. So I talk to a lot of people in this area. And again, you got to look at it in the areas, right? More condensed areas like New Jersey or New York, or parts of Miami or California, obviously are going to hold up differently than, somewhere in the middle of the country, right? So you got to look at that demographic. The big thing is every investor in the last couple of years knows how hard it's been to secure financing. As long as the secondary market doesn't go negative, right? That's the big scare that people don't talk about. People talk about, oh, so there's two sectors of the market, right? You have the real estate market as a whole, and then you have the secondary market, like what happened in 2008, and we don't like to use those words. If a lot of investors have not been able to really invest much, I haven't bought something since pre-COVID because I'm not going to buy something $150,000 over market value. Doesn't make much sense to me. So if the market continues to decline the way it is, you have a lot of investors sharpening their teeth right now to get into that market, to be able to buy, at a lower, at a lower price. That's fine. The big thing is paying close attention to the secondary market, because if you have an issue with that and nobody can lend because paper can't trade, that's where you're going to have a big crunch. And that's what we've been gearing up for, to heavily prepare so we don't have that issue ourselves as a company. Because as you can see, a lot of companies are closing down.
Yeah, they are.
And a big reason for that is that they didn't manage their paper correctly. I'm not going to name names, but they weren't able to manage their paper and their secondary market correctly. And then they got stuck with $500 million in their pipeline. That's where they closed down.
All right. Well, I got to tell you, Michael, it's been a pleasure speaking with you. It's a good wrap up, and I really appreciate the education on what's happening in the marketplace and what it provides. So with that being the case, thanks very much for being here today. We do appreciate your insights, and wish you a continued excellent luck through the end of the year and into the next year.
Thank you so much.